we had a period of great reform in the Depression.
Yes.
And then there was another period of reform in the 70s.
Yes.
In finance.
Right.
What went wrong?
Many things. I mean, it's sort of like asking what caused the Second World War. Lots of things.
Sure.
So, but I focus in my book on two things. One is the embrace of flawed finance and economics, which assumed that there was no real uncertainty in this world. An embrace not just in academia, but by politicians and by the financial industry itself. Now, it was a self-serving embrace, because if you can mass produce finance, then you can have very large, complex institutions, supposedly. Sort of, we can turn banking into a General Motors, producing a gazillion cars, where the person running it really doesn't need to know what is going on the factory floor. Whereas if finance is judgment-based, the natural size or scope, more importantly, of financial institution is limited.
You reach at the end of this book some conclusions, some policy conclusions, which, to simplify, is a sort of utility banking system, which would take the depository and the payment system functions of the banks and regulate them tightly, and let other parts of the system, the securities parts, to relatively unregulated, which would bring us back to a sort of Glass-Steagall split, not exactly what Glass-Steagall was.
Tougher than Glass-Steagall.
If you highly regulate the banks, you do seal them off from the rest of the financial system. Is there a danger of allowing them to decay as institutions?
There is a certain amount of sleepiness that enters regulated institutions. I am not suggesting a riskless banking system. There are people who have suggested that that's what we want. We want a completely riskless banking system.
100%.
100% in treasury bills. I'm saying banks should take risks, but they should take risks in the way they used to take risks, where it's on a case-by-case basis, and where diversification is sort of the last step in assuring the soundness of the bank, not the first step.